Your grandfather sat by the radio every Sunday night. He didn't say much. He just listened, hands folded, like he was in church. You always thought it was nostalgia, a quiet habit from another era, something people did before television, before the internet, before there was anything else to do on a Sunday. It wasn't nostalgia. It was survival, learned in March of 1933, when the whole country was one bank run away from collapse. Have you ever wondered what it actually felt like to not trust your own bank? Not to worry about the stock market or interest rates or some abstract number on a screen. To wonder if the building on Main Street, the one with your family's savings inside it, would even be open tomorrow morning. By the time Franklin Delano Roosevelt took office in March of 1933, more than 9,000 banks had already failed across the country since the crash of 1929. 9,000. That number is almost too large to picture. So picture this instead. That's not 9,000 buildings closing. That's millions of family savings disappearing, not to theft and not to some financial trick, just to panic. Here's how it actually worked. One person heard a rumor that a bank was in trouble. They rushed down and pulled their money out just to be safe. Their neighbor saw the line forming outside and panicked too. Because a line outside a bank looks like proof that something is wrong, even when it isn't yet. Within days, a perfectly healthy bank could be emptied out completely. Economists have a name for this. They call it a bank run. It sounds dramatic, but the mechanism behind it is simple, almost mundane. A bank doesn't keep all your money sitting in a vault. It keeps a fraction of it there and loans the rest out. To a farmer buying seed or a young couple buying their first house. That's how a bank earns anything at all. But if everyone asks for their cash back at the same moment, there isn't enough sitting there to give them. Not because the bank stole anything, just because fear moves faster than money ever can. So on March 6, 1933, only 2 days after his inauguration, Roosevelt did something no American president had ever done before. He shut down every single bank in the entire country, all at once. Historians call it the bank holiday. For 4 straight days, the United States ran without a single functioning bank. People bartered with each other. Store owners extended credit on a handshake. Families waited, not knowing what would happen next. Then, on the evening of March 12, 1933, he did something else no president had really done before either. He got on the radio and he talked to the country the way you'd talk to someone sitting across your own kitchen table. That was the first fireside chat. He didn't use complicated language, and he didn't talk down to anyone. He explained, in plain terms, exactly how a bank works, why some of them had failed, and why it was now safer to put your money back in than to keep it hidden away. He told the country, quite simply, that it was safer in a reopened bank than under a mattress, and people believed him. Within the next 2 weeks, more money flowed back into the banking system than had fled out during the entire panic that came before it. Historians still point to that reversal as one of the fastest recoveries of public trust in American financial history. Why did it actually work? Because Roosevelt understood something that most leaders, even now, still misjudge. People don't panic simply because the numbers are bad. People panic because nobody bothers to explain the numbers to them at all. Picture a family in Dayton, Ohio, in the early spring of 1933. The father had pulled every dollar out of the bank 2 months before, wrapped it carefully, and buried the tin behind the tool shed. His wife thought he had lost his mind. Down the street, his neighbor had done the exact same thing, quietly, without either man ever mentioning it to the other. Back then, nobody talked about money out loud. It felt shameful, almost, to admit that you were frightened. Then, that Sunday evening, the family gathered close around the radio in the front room. The father leaned in, the same way your own grandfather would decades later. And for the first time in months, he heard someone in Washington explain, calmly and without any spin or blame, exactly what was happening to his money and why. Just one person, speaking plainly, like a neighbor talking to another neighbor over a fence. 2 weeks later, he dug the tin back up. He walked it down to the bank and he put it back in. That single decision, repeated in millions of households across the country that same spring, is a large part of why the American banking system survived 1933 at all. Here's the counterintuitive twist, though. The fireside chats didn't succeed because Roosevelt promised the country that everything would be fine. He never actually made that promise, not once. What he did instead was tell people the truth, clearly, on a regular schedule, whether the news that week happened to be good or difficult to hear. That same year, Congress passed the Banking Act of 1933, the law that created the Federal Deposit Insurance Corporation. For the very first time, an ordinary depositor's savings, up to $2,500, were insured directly by the federal government. If your bank failed after that, you no longer lost your savings along with it. That insured amount has grown steadily in the decades since. Today, the FDIC insures deposits up to $250,000 per depositor per bank. Most people never think about that number at all. They simply trust it, the way you trust a stoplight to mean stop. That trust wasn't automatic. It was built, deliberately, out of the wreckage of 1933. 2 years later, in 1935, Roosevelt returned to that same instinct, this time to a different problem. Before the Social Security Act of 1935, growing old in America often meant becoming financially dependent on your children, or on almost nothing at all. There was no broad national safety net for the elderly. Roosevelt again went on the radio to explain it plainly, framing Social Security not as charity, but as something workers themselves would pay into over a lifetime, and later draw back out. That single piece of legislation reshaped what retirement even meant for the following century of American families, including, quite possibly, your own parents. Years later, the economist Milton Friedman, working alongside Anna Schwartz in their landmark study of American monetary history, argued that much of the damage during the Depression came not only from the initial economic shock of 1929, but from the collapse of public confidence that followed it, and the Federal Reserve's failure to respond to that panic quickly enough. Confidence, it turns out, was never a soft, sentimental side note to economics. It was the actual mechanism holding the whole system together. Roosevelt understood this well enough to keep using it, again and again, for the rest of his presidency. He delivered 30 of these fireside chats in total, spread out over 12 years, right up through the middle of the Second World War. He didn't rely on them only in the worst months of the Depression. He used the same steady, honest format in 1937, when a second, sharper downturn briefly threatened to undo the progress the country had made, largely because government spending had tightened too quickly, too soon. He used it again to explain war bonds, rationing, and why ordinary families were being asked to plant so-called victory gardens in their own backyards. The topic changed almost every time. The method never did. Explain plainly. Explain honestly. Explain on a schedule people could count on, rather than only when the news happened to be good. That consistency was the real innovation, more than any single speech. A family that trusted the voice on the radio in March of 1933 was far more likely to still trust it in 1935 or in 1941. Trust, once it's rebuilt carefully, tends to compound, almost like interest. It grows quietly in the background, and you rarely notice how much you've accumulated until the one moment you desperately need to draw on it. So why should any of this matter to you? Sitting here decades later, in a financial world Roosevelt could never have imagined. Because the instinct your grandfather carried, that habit of checking in, staying informed, wanting a straight and honest answer instead of a vague reassurance, that instinct was never old-fashioned. It was correct, and it still is. It's the same instinct that should guide you today, whether you're looking at a retirement statement that doesn't quite make sense, or a call from your bank you're not fully certain is legitimate, or a difficult family conversation about what happens to an account once a parent passes on. The families who came through 1933 in the best shape weren't the ones who panicked, and they weren't the ones who simply buried their heads in the sand either. They were the ones who stayed calm, asked plain questions, and expected plain answers in return. That's a habit worth passing down deliberately. Not a fear of banks, just a quiet refusal to let confusion sit unanswered for one day longer than it has to. Think about how often that same instinct gets tested today, in ways your grandfather never had to face. A phone call claiming to be your bank, asking you to confirm account details out loud. A letter about a Medicare or Social Security change written in language that seems designed to be skimmed rather than understood. A well-meaning adult child suggesting you move your savings into something they don't fully understand themselves. In every one of those moments, the temptation is the same one families faced in 1933. Either panic and act too fast, or freeze and avoid the subject entirely. Roosevelt's fireside chats suggest a third option, the one that actually worked. Slow down. Ask for the plain explanation. Don't move a single dollar until you have it. Maybe that's worth a conversation with your own children or grandchildren this week. Not about a tin buried behind a tool shed, about what you actually want them to understand clearly, calmly, well before they're ever forced to guess. Where the important documents are kept, who to call first if something ever feels wrong with an account, what you would want done and what you wouldn't. Said once, plainly, while there's no crisis forcing the conversation, is worth more than anything explained later, in a rush, during an emergency. Your grandfather sat by the radio every Sunday night. He wasn't waiting for good news, he was waiting for the truth. And once he finally had it, he could stop being afraid.